Everyone, myself Dr. S. Mohamed Nazeer. This class I'm going to teach you fiscal economics. In fiscal economics, budget. Before I'm going to explain budget, I'm going to explain you fiscal policy and its role. What is fiscal policy? Fiscal policy is a policy of government revenue and government expenditure. It has three basic objectives: equity, growth, and stability. These are the basic objectives of fiscal policy. Let's see the role of fiscal policy in economic development. The fiscal policy plays an important role in economic development of an economy. Number one, acceleration of economic growth. In a developing country, the fiscal policy helps to accelerate the rate of economic growth. It can be possible when the revenue collected from taxes is invested in the productive activities and the public expenditure used for the development activities. I repeat, it can be possible. Acceleration of economic growth can be possible when revenue collected from taxes is invested in productive activities and the public expenditure is used for the developmental activities. It helps in raising the level of savings and investment in the economy. The second role, increase in employment opportunities. Fiscal policy helps in increasing in the employment opportunities in the developing country. Government increases the public expenditure to raise the production and employment opportunities. Employment opportunities can be raised when propensity to consume is increased. Okay, the employment opportunities can be raised when the propensity to consume is increased. Government imposes taxes on rich people and distribute it to poor to raise the consumption. Okay, then automatically the propensity to consume will increase. This also takes a resort of public borrowing to increase investment in employment generating projects. The third role, reduction in inequalities of income and wealth. Reduction in inequalities of income and wealth. Fiscal policy also helps in minimizing the inequalities of income and wealth. It can be done by imposing huge taxes on rich people to curtail their unnecessary expenditure. Okay, while the poorer section is kept exempted from taxes. For rich people, government want to put more taxes, poor people exempted. The government must spend collected from revenues for the benefit of the poor people. That will reduce the inequalities of income and wealth. The fourth role of fiscal policy is maintain price stability. Fiscal policy helps in maintaining in the price stability in the economy. For this purpose, government adopts anti-inflationary measures through tax imposition and public borrowing. The excess purchasing power of the people is withdrawn. People are encouraged to save more and cut their inessential expenditures. Okay, inessential expenditure. These are the role of a fiscal policy. Let's see, what is budget? Budget is an important instrument used to describe the fiscal policies of the government and the financial plan corresponding to them. Okay, I repeat. Budget is an important instrument. Okay, budget is an important instrument used to describe the fiscal policies of the government and the financial plans corresponding to them. Technically, a budget shows the financial accounts of the previous year. Financial account of the previous year, the budget estimate and the revised estimates of the current year. budget estimates and revised estimates of the current year and the budget estimates of the coming year. I repeat, a budget shows the financial accounts of the previous year, the budget estimates and revised estimates of the current year, and the budget estimates of the coming year. Okay, it can be understood with the help of budget at glance. This is budget at a glance for the year 2020-21. Normally, the budget is presented on February 1st. Okay, so in the February 1st, the budget presented in the parliament. Okay, in the budget document, it shows the financial account of the previous year. Okay, 2018-19 is the previous year of the previous financial year. Okay, the actuals of the previous financial year accounts, and then the current financial year 2019-20. Okay, 2020 March 31st only this financial year will get over. So the current financial year budget estimate and current financial year revised estimate. This year actual will get in the next year only. Okay, in the next year we get the actuals for this 2019-20 financial year. So the budget shows the financial accounts of the previous year 2018-19. Okay, and the budget estimate and the revised estimates of the current year and the budget estimates of the forthcoming year, that is coming year 2020-21. So budget shows the financial accounts of the previous year, the budget estimate and revised estimate of the current year, and the budget estimates of the coming year. A government budget is a statement showing item-wise estimated receipts and estimated expenditure under various heads during a fiscal year, which runs from April 1st to March 31st. So the fiscal year which runs from April 1st to March 31st. Article 112 of the Constitution of India states that an annual financial statement will be placed before both Lok Sabha and Rajya Sabha. This is called the budget of the central government. I repeat, Article 112 of the Constitution of India states that an annual financial statement will be placed before both Lok Sabha and Rajya Sabha. This is called the budget of the central government. Similarly, each state government, according to Article 202, is required to lay on annual financial statement before the legislature of the state. This is called the budget of the state government. Okay, this is the meaning of budget. Let's see the objectives of budget. There are 4 important objectives: redistribution of income and wealth, reallocation of resources, economic stability, managing public enterprises. Let's see one by one. Redistribution of income and wealth. Government, through fiscal tool of taxation, subsidies and transfer payments, bring about fair distribution of income. Equitable distribution of income and wealth is a way to bring social justice. It is the first objective of the budget. The second objectives: reallocation of resources. The government, through its budgetary policy, reallocates resources so that social and economic objectives are met. Private firms do not find it profitable to produce public goods like park, bridges, national defense, etc. Government allocates its resources and produce these goods which maximize social benefits. This is the second objective of the budget, reallocation of resources. The third objective, economic stability. The government tries to prevent business fluctuations and maintain Price and economic stability. Economic stability stimulates, okay, I repeat, economic stability stimulates inducement to investment and increase the rate of growth of development. It is one of the objectives of the budget. The fourth objective, managing public enterprises. The budgetary policy of the government shows interest of the government to increase the rate of growth through public enterprises. Often, public sector enterprises are encouraged in areas of natural monopolies. For example, water lines, railways, etc., where there are advantages if a single firm produces a commodity. These are the objectives of the budget. I repeat, redistribution of income and wealth, reallocation of resources, economic stability, managing public enterprises are the main objective of the budget. Let's see the impact of budget. The budget impacts an economy at three levels. Number one, it brings aggregate fiscal discipline level. Okay. Number two, it brings better allocation of resources. Number three, it has affect the efficient provision of programs. These are the impacts an economy of the budget. Let's see one by one. It brings aggregate fiscal discipline level. That is to say, having control over expenditure. Fiscal discipline will mean a situation of an ideal balance between revenue and expenditure of the government. There must be essential check on expenditure since the revenue of the government are limited. Okay, through the budget. Okay, through the budget, we can bring the aggregate fiscal discipline level. The second impact, it brings better allocation of resources. Budget brings the better allocation of resources. That is to say, priority must be given to social sectors. Government, through its two important budgetary instruments, taxations and subsidies, will allocate resources to those areas where society's welfare is maximum. In this way, it will bring about the equitable distribution of income and wealth. The impact of budget is bring better allocation of resources. The third impact, it has effective and efficient provision of programs. Effectiveness measures the extent to which government achieves its targets. Efficiency refers to the minimum cost per unit of goods and services produced. Through the budget, we can achieve the effective and efficient provisions of programs. These are the impact of budget. Let's see the components of government budget. There are two components, revenue budget and a capital budget. Let's see this with the help of diagram. This is the components of the government budget. Okay, government budget has two components, budget receipts and budget expenditure. Here, revenue receipts, capital receipts. Here, revenue expenditure and capital expenditure. Let's see this in detail. Let's see the budget receipts. What is budget receipts? The government needs fund to finance its activities. Such funds are raised from various sources. The sources can be taxes, price of goods and services supplied by public enterprises, fees, fines, gift, grants, etc. Thus, budget receipts are estimated money receipts of the government from all sources during the fiscal year. Okay, this is called the budget receipts. Let's see the components. The main components of revenue or public revenue are divided into two main categories, revenue receipt and capital receipts. Our constitution under Article 112 make it compulsory to divide our budget under revenue receipt and capital receipts. Okay, let's see one by one. What is revenue receipt? Revenue budget take care of the current receipts and running expenses like tax revenues, interest, dividend and profits. Revenue receipts are receipts under revenue account. Revenue receipt does not either create a liability or lead to reduction in assets. This is the important thing. Revenue receipt does not either create liability or lead to reduce in assets. Okay, the revenue receipts can be divided into tax revenue and non-tax revenue. Let's see one by one. Receipts from tax revenue. What is tax? A tax is a legally compulsory payment imposed by the government. Government imposes tax on income, manufacturing, sales, transportation, wealth, gift, properties, exports and imports, etc. Types of tax. There are two types of tax: direct tax and indirect tax. Okay. When the liability to pay a tax and the burden of that tax fall on the same person, it is called a direct tax. I repeat, when the liability to pay a tax and the burden of that tax fall on the same person is called a direct tax. For example, income tax is a direct tax because the liability of paying this tax is of the person on whose income it is levied and its burden also falls on him. The burden of this tax cannot be shifted onto others. Some other examples of direct tax are gift tax, wealth tax, corporation tax. Okay, so the direct tax. When the liability to pay a tax and the burden of that tax fall on the same person is called a direct tax. Let's see what is indirect tax. When the liability to pay a tax and the burden of that tax can be on different person, it is called a indirect tax. For example, sales tax, okay, GST is an indirect tax because the liability to pay sales tax or GST is that of the shopkeeper, but he shifts the burden of this tax on the customers. Some other examples are entertainment tax, tax on services, excise duty, etc. These are called indirect tax. When the liability to pay a tax and the burden of that tax can be on different persons, it is called a indirect tax. Let's see the receipts from non-tax revenue. Okay, what is non-tax revenue? Non-tax revenue refers to the revenue receipts of the government from sources other than tax. Okay, let's see some types of non-tax revenue. Commercial revenue, administrative revenue. Okay, these are the types of non-tax revenue. See, in the commercial revenue, it is revenue received by the government by selling the goods and services produced by the government agencies. Examples: payment for postage, toll, interest on funds borrowed from government credit corporations, also includes interest and dividend on investment made by the government. What is administrative revenue? It is a revenue that arises from administrative function of the government. For example, fees. This is non-tax revenue, fees. A payment of defray the cost of each recurring services undertaken by the government. It gives a special advantage to a fee payer. Example, college fees, registration fees, etc. Fines and penalties. Forfeitures. Escheat. What is forfeiture? A penalty imposed by court for non-compliance with orders. That is called forfeiture. This revenue is going to government. That is non-tax revenue. Escheat. What is escheat? A claim of the government on the property of a person who dies without having any legal heirs, without leaving a will, without having a legal heir. So the government will take over that property. It is called a escheat. These are all called under a non-tax revenue of the government. Okay. This is the revenue receipts. So the revenue receipt, what is revenue receipt? This receipt does not either create a liability or lead to reduction in asset. It has two types, tax revenue, non-tax revenue. Okay. Now, capital receipts. Capital budget cover the creation and disposal of assets and liabilities. Capital receipts are receipts under capital account. Capital receipts include market borrowings, external loans, recoveries of loan, and advances made by the government and provident fund. This receipt either create a liability or leads to reduction in assets. For example, disinvestment of public sector undertakings. In the budget, capital receipts are classified into three groups: recovery of loans, borrowing and other liabilities, other receipts. Okay, let's see one by one. Recoveries of loan. It includes recovery of loans granted by the central government to the state and union territory governments and other parties. It is a capital receipt because it reduces financial assets of the government. Number 2, borrowings and other liabilities. Borrowings creates a liability. Government raises loans from the market, Reserve Bank of India, foreign governments and other bodies. So borrowings and other liabilities are one of the form of capital receipt. The third one, other receipt. Other receipts include capital receipts other than the recovery of loans and borrowings. Funds raised from disinvestment is one such receipt. Disinvestment means selling a part or whole of the shares, that is to say the equity, of the public sector enterprises held by the government. It is defined as withdrawal of one's investment in a company. It is called a capital receipt because it reduces the assets of the government. So, capital receipt either create a liability or leads to reduction in assets. Let's see the components of public revenue. Revenue receipt, capital receipt. Components, tax revenue. Okay. Taxes on income and expenditure. Income tax, corporation tax, expenditure tax. Okay. Tax on property and capital transactions. That is to say, estate duty, wealth tax, gift tax, land revenue. Taxes on commodities and services. For example, GST. These are the components of a revenue receipt. Let's see the components of capital receipts. Market borrowing, including special bonds. External loans raised by the central government from abroad. Recoveries of loans and advances made by the central government. Okay. The Provident Fund. The State Provident Fund and Public Provident Fund is the capital receipts components. Okay. Here, this side, revenue receipt. These receipts do not create any corresponding liability for the government. Revenue receipt. Capital receipts create a liability for the government. Revenue receipts do not cause any reduction in assets of the government. Capital receipts cause reduction in assets of the government. These are regular and recurring in nature. Regular and recurring in nature. Capital receipts are irregular and non-recurring nature. Okay, these are the components of public revenue. Let's see the budget expenditure. Budget expenditure is the expense which the government incurs for its own maintenance as also for the society and the economy as a whole. Budget expenditure is defined as the expenditure of the central, state and the local governments on various social, economic, political activities in the country. The objectives of such expenditure is to promote public welfare. That is to say, budget expenditure should be on such areas which help in achieving the objectives of the fiscal policy. Okay, let's see the components of budget expenditure. There are two components, revenue expenditure and capital expenditure. Let's see one by one. Revenue expenditure. Revenue expenditure which does not result in creation of assets or reduction of liability. I repeat, revenue expenditure which does not result in creation of asset or reduction of liability is treated as revenue expenditure. Such expenditures are incurred for the normal running of the government departments and the maintenance of services. For example, salaries, pensions, interest payment, subsidies, grants, etc. Okay, this is called the revenue expenditure. Let's see the capital expenditure. An expenditure which leads to creation of assets or reduction in liability. Creation of assets or reduction in liability is treated as capital expenditure. For example, expenditure on purchasing land, building, shares, etc. It also includes loan granted to the state and union territories, foreign governments, public enterprises and other parties. Repayment of loan is also capital expenditure because it reduces the liabilities of the government. Okay, so the capital expenditure is expenditure which leads to creation of assets or reduction in liabilities. Okay, revenue expenditure which does not result in creation of asset or reduction of liability. Okay, this is the budget expenditure, revenue expenditure and capital expenditure. Now I am going to explain balanced, surplus and deficit budget. Okay, let's see one by one. A budget may be unbalanced or balanced. Unbalanced or balanced. Unbalanced budget. In this, receipts are not equal to expenditure of the government. Receipts are not equal to expenditure of the government. It is of two kinds, surplus budget and a deficit budget. Let's see one by one. Surplus budget. It is one where estimated revenue are more than the estimated expenditure. Revenue is more than the expenditure, called the surplus budget. Now see the deficit budget. It is one where estimated revenue is less than the estimated expenditure. So revenue is less than the expenditure, called the deficit budget. Let's see the balanced budget. It is one when estimated revenue are equal to estimated expenditure. Okay, in other words, amount of tax is equals to amount of expenditure. Okay, this is called a balanced budget. Let's see the measures of government deficits. It is very important concepts in budget. Measures of government deficits. Generally in developing countries, the budget has a deficit showing excess expenditure over the revenue. A distinction is necessary between these three of deficits, namely revenue deficit, fiscal deficit and primary deficit. Let's see the revenue deficit. Revenue deficit are defined as the excess of revenue expenditure over revenue receipt. I I repeat, revenue deficit are defined as the excess of revenue expenditure over revenue receipts. So we get it. Revenue deficit is equals to revenue expenditure minus revenue receipts. Okay, this is called a revenue deficit. Let's see the fiscal deficit. Fiscal deficit is a wider concept. It is sum of borrowing and other liabilities of the government. I repeat, the fiscal deficit is the sum of borrowings and other liabilities of the government. It is calculated by the formula, that is, the fiscal deficit is equals to total expenditure minus total receipts other than borrowings and other liabilities. Now, primary deficit. Primary deficit is equals to fiscal deficit reduced by interest payments. So, the primary deficit is equals to fiscal deficit minus interest payments. If, okay, zero primary deficit means that the government has to resort to borrowing only to make interest payments. So, the government don't have money for development purpose. Only the borrowing amount is going for interest payments. If the primary deficit is zero. The significance of primary deficit is primary deficit indicates borrowing requirements of the government to meet deficit net of interest payments. Okay. Let's see the measures to correct the different deficits. Deficits may be financed by the following ways. Deficit financing or monetary expansion. It means that government can print currency notes to the extent of the deficit. It involves borrowing by the government from the central bank through the issue of treasury bills of the central bank. The central bank buys the treasury bills and the government gets cash to fund its deficit. What we can say there? One of the way to correct the deficit is deficit financing. The second one, borrowing from the public. The government may raise loans from the general public by issuing bonds of various types. Borrowing from the public is one of the way to correct the deficit. Disinvestment. The government may choose to sell its existing shares in public sector enterprises. Okay, this is called a disinvestment. This proceeds can be used to fund the deficit. So disinvestment is one of the way to correct the deficit. The fourth one, lowering government expenditure. The government should take all necessary steps to reduce the non-developmental expenditure. The government can also reduce its expenditure by giving greater role to private sector in the development process. It is one of the way to reduce the deficit, lowering the government expenditure. Then, raising government revenue. Government should take steps to restore balance between direct and indirect taxes. There is a scope of have wider coverage in indirect taxes. These are the ways: monetary expansion or deficit financing, borrowing from the public, disinvestment, selling the public sector undertaking shares to the public, lowering government expenditure, increasing in the government revenue through the direct and indirect taxes. These are called measures to correct the different deficits. Okay, so we know there are three deficits: revenue deficits, fiscal deficits, and primary deficits. Okay, in this class we've seen what is fiscal policy and its role, what is budget, what its objectives, what's its impact, what is structure, what is revenue receipt, what is revenue expenditure, what is capital receipt, what is capital expenditure, what is revenue deficit, what is fiscal deficit, what is primary deficits. Let's see this year budget 2021 budget, we can understand these concepts. This is budget at a glance for the year 2020-21. We know that budget shows the financial accounts of the previous year, the budget and revised estimates of the current year, and the budget estimates of the coming year. Look here, 2019-20 is the current financial year. 2020 February 1, the budget presented in the parliament. Okay, so that budget shows the 2018-19 actual. This is the financial account of the previous year. So the current year budget estimate and current year revised estimate and the budget estimates of the coming year shows in the budget. Look here, revenue receipt and capital receipts. So revenue receipts, how much is the revenue receipt? 20,926 lakh crore. So the revenue receipts categorized tax revenue and non-tax revenue. Look here, the tax revenue 16 lakh 35,909 lakh crores. Non-tax revenue here 38,000 what we can say 3,85,017 lakh crores. If we add this tax revenue and non-tax revenue, we get the revenue receipts and the capital receipt. Capital receipts amount is 10 lakh 21,304 lakh crores. So under capital receipts, recovery of loans, other receipts, borrowing and other liabilities are there. Let's see one by one. The recovery of loans. Here, the recovery of loans 14,967 lakh crores. Other receipts. Okay. What we can say? The 2,10,000 lakh crores. Borrowings and other liabilities 7,96,337 lakh crores. If we add these three, we get the capital receipts. If we add this capital receipt and revenue receipt, this plus this, we get the total receipt. So the total receipt of the budget 2021 is 30 lakh crore 42,230. Okay. So around we can say that 30 lakh crore rupees is the total receipts of the forthcoming year budget, forthcoming year 2021 receipt. So then the total expenditure. Total expenditure is also 30 lakh crore 42,230 rupees. See, look here, under total expenditure on revenue account of which 26 lakh crore 30,145. Interest payment. So interest payment is what we can say 7 lakh 8,203 crores. Grants in aid for creation of capital asset is 2,06,500 crores. On capital account, okay, on capital account 4 lakh. On capital account 4 lakh 12,085. So if we add this 10 and 13 on revenue account of which this amount 26 lakh plus this 4 lakh, we get the total expenditure. Okay, on a revenue account of which in that interest is paid this amount and the creation of capital asset is this amount. Okay, these are the total receipts and total expenditure. Let's see the deficits. The first one is the revenue deficit. Revenue deficit is 10 minus 1. 10 is nothing but the revenue account expenditure minus revenue receipt. So the revenue account expenditure is 26 lakh crore, around 26 lakh crore. Now the revenue account receipt is 20 lakh crore. So 26 minus 20 lakh crore, 6 lakh crores. See, look here, the 6 lakh 9,219 crore is the revenue deficit, which is 2.7% of GDP. This amount is 2.7% of GDP. This is called a revenue deficit. So the revenue expenditure greater than the revenue, what we can say, the revenue. Expenditure is greater than the revenue. Revenue expenditure is greater than the revenue receipt. So this is the amount, 2.7%. In order to calculate the effective revenue deficit, 14 minus 12. 14 is the revenue deficit. Revenue deficit is around 6 lakh crore minus this 12. Grants in aid for creation of capital asset. This is 2 lakh crore. If we reduce from this 6 lakh crore, okay, this creation of capital asset only, it is good for the country. then we can find the effective revenue deficit. So 6 lakh minus this 2 lakh, we get 4 lakh 2,719 crores. So the 4 lakh crore is the effective revenue deficit. That is the 1.8% of the GDP. Then the fiscal deficit. Fiscal deficit nothing but 9. So 9 is the total expenditure minus 1 plus 5 plus 6, 1. So the revenue receipt. 1 is the revenue receipt. 5 is the recovery of loan. Okay, 6 is the other receipts, excluding the borrowing and liabilities. If we add this, then we subtract from the total expenditure, we get this amount, fiscal deficit amount. That is 7,96,337 crores, around 8 lakh crore. This amount, the 7,96,000 is nothing but the borrowings and other liability amount. Okay, which is 3.5% of GDP. Fiscal deficit is 3.5% of GDP. And then the primary deficit, 16 minus 11. Fiscal deficit minus interest payment. See, the fiscal deficit, the borrowing is 7,96,337. In that, we are paying interest. We are paying interest 7,08,203. The remaining is only the 98,134. This is the primary deficit, which is 0.4% of the GDP. This is the budget at a glance of 2021.